The event, what just happened, and why it shocked the market. It was late January, and the silver market delivered a move that caught almost everyone off guard. Prices that had recently been climbing at an aggressive pace suddenly reversed. In a very short period of time, silver fell sharply, erasing a large portion of recent gains. For many watching the screen, it felt sudden, violent, and deeply unsettling. Headlines quickly followed, charts turned red, and confusion spread across trading desks, online forums, and investor conversations. From the outside, the event looked simple. Silver had gone up fast, and then it dropped hard. But markets are rarely that simple. What made this move so shocking was not just the size of the dip, but the speed at which it happened. A decline of this scale, occurring within hours rather than weeks, triggered alarm bells across the financial world. For participants who entered near recent highs, the drop felt personal. For observers, it raised a more serious question. Had something fundamentally broken? Silver had recently been trading at levels that many considered historic. Prices were not just rising, they were accelerating. Momentum was strong, daily ranges were expanding, and volatility was becoming the norm rather than the exception. This type of behavior tends to attract attention quickly. New participants enter, media coverage increases, and expectations begin to rise faster than the market itself. That environment creates excitement, but it also creates fragility. When the dip arrived, it did not arrive quietly. Prices moved lower in large steps, not small ones. This is important. Slow declines allow people time to think. Fast declines force reactions. In this case, the speed of the move caused many participants to act before fully understanding what was happening. Some sold out of fear, others froze, unsure whether this was a normal pullback or the start of something much worse. At the same time, gold also moved lower, but the contrast between the two metals was striking. Gold's decline was noticeable, yet controlled. Silver's decline was sharper and more dramatic. This difference added to the confusion. If both metals were part of the same broader trend, why was silver reacting so much more violently? The answer was not obvious to most observers in the moment, which only added to the shock. Another factor that amplified the reaction was timing. The dip followed closely after a period of very strong upward movement. Just days earlier, silver had been trading at significantly higher levels. Many participants were still mentally anchored to those prices. When markets move down quickly after such a run, it creates a sense of loss, even if prices remain historically high. Human psychology struggles with rapid change, especially when it moves in the opposite direction of recent expectations. Importantly, this event occurred during a period of extreme intraday volatility. Silver was not moving 1 or 2% at a time. It was swinging by double digits within a single session. In such an environment, price becomes less of a signal and more of a reflection of stress. Markets under stress behave differently. Liquidity thins, spreads widen, and small imbalances can lead to large moves. These conditions make normal interpretation difficult. For many in the business and investment community, the shock came not just from the dip itself, but from what it seemed to imply. A sudden drop often triggers a narrative of failure. People begin to ask whether the move up was a mistake, whether the asset was overvalued, or whether unseen risks have suddenly appeared. These questions are natural, but they are not always productive in the heat of the moment. What made this event especially challenging was the flood of conflicting opinions that followed. Some voices declared the move a clear warning. Others dismissed it as noise. Very few paused to separate emotion from structure. In fast markets, the loudest interpretations often spread the fastest, regardless of accuracy. This creates a feedback loop where fear feeds on uncertainty, and uncertainty feeds on price movement. Yet, beneath the surface, something important was happening. The dip was not occurring in isolation. It was part of a broader pattern that tends to emerge during periods of rapid repricing. Markets that move quickly upward rarely do so in straight lines. They pause, they pull back, and they test conviction. These tests often feel uncomfortable, but they serve a purpose. At this stage, the key mistake many observers made was assuming that shock equals damage. In reality, shock often signals transition. The market was not necessarily rejecting higher prices. It was responding to them. Understanding that difference is critical, especially for serious participants who must make decisions based on structure rather than emotion. This event was not just about a dip in price. It was about how markets behave when momentum, expectations, and liquidity collide. To understand why this move happened and what it actually means, it is necessary to look beyond the chart and examine the forces underneath it. That requires moving past the event itself and into the mechanics that drive such moments. And that is where the real story begins. The mechanics, what forced the market to move this way. What followed the initial shock was not calm, it was tension. Behind the falling price, forces were moving that most participants never see in real time. Silver was not simply being sold because people changed their minds. Much of the selling was not a choice at all. It was forced. As silver rose rapidly in the days before the dip, Leverage quietly increased across the market. Traders used borrowed capital to amplify gains. Short-term positions stacked on top of one another. Each new price increase encouraged more exposure. This behavior is common in fast-moving markets, especially when confidence grows faster than caution. But leverage has a hidden cost. It removes flexibility when prices reverse. When silver began to fall, the first selling did not come from long-term holders. It came from pressure. Margin requirements started to matter. Accounts that were comfortable hours earlier suddenly became unstable. As prices dropped, margin calls followed. Positions had to be reduced, not because belief changed, but because rules demanded it. This is how forced behavior begins. Once forced selling starts, it rarely stays contained. One liquidation pushes price lower, which triggers the next. This creates a chain reaction. The market stops responding to value and starts responding to mechanics. In these moments, price does not reflect judgment, it reflects urgency. Liquidity plays a critical role here. During calm conditions, buyers and sellers meet easily, but during sharp moves, liquidity thins. Orders disappear. The market becomes fragile. Small sell orders can move price far more than expected. This is why silver dropped in large steps rather than smooth declines. The structure underneath the market was strained. At the same time, algorithmic systems amplified the move. Many trading models respond to volatility and momentum, not fundamentals. When certain thresholds are crossed, these systems act automatically. They do not ask whether the move makes sense. They execute. In fast markets, automated behavior can dominate human decision-making, especially during intraday swings. Another critical factor was the difference between paper silver and physical silver. Most of the price action occurred in the paper market, where contracts can be bought and sold instantly. Physical silver does not move that way. It does not react to every tick on a screen. But the paper market sets the headline price, and that price influences perception everywhere. This disconnect creates confusion. Observers see price falling rapidly and assume demand has collapsed. In reality, much of the movement reflects positioning, not consumption or long-term ownership. Paper markets can change direction in minutes. Physical markets move slower and often tell a different story. As the dip deepened, fear spread faster than information. People watching the market saw only the result, not the process. They saw red numbers and assumed intention. But markets under stress are driven by constraints, not opinions. Understanding this difference is essential. There was also a timing element that increased the power of the move. The dip occurred after a period of extreme optimism. Many participants were positioned the same way. When everyone leans in one direction, even a small push the other way can cause imbalance. This is not a flaw in silver, it is a feature of crowded markets. Importantly, none of these forces require a change in the long-term outlook. They operate independently of belief. A trader can be bullish and still be forced to sell. An institution can expect higher prices and still reduce exposure due to risk limits. Forced behavior does not reflect conviction. It reflects survival. This is where suspense builds for serious observers. If the dip was driven by mechanics rather than meaning, then the real question is not, why did price fall? The real question becomes, what happens after forced behavior runs its course? Historically, markets often behave differently once pressure eases. When forced sellers are cleared, the market regains balance. Price begins to respond again to real demand and real scarcity. But this transition is never obvious in the moment. It happens quietly while attention remains fixed on fear. The danger lies in misunderstanding this phase. Many participants exit during mechanical stress, believing they are reacting to information. In reality, they are reacting to noise. Those who fail to distinguish between forced selling and voluntary selling often make decisions they later regret. At this stage, silver was not proving weakness. It was revealing structure. And the dip exposed how tightly wound the market had become. It showed how quickly leverage can turn from advantage to liability. And it set the stage for the most important part of the story. Because once mechanics are understood, interpretation changes. And when interpretation changes, behavior follows. The next question is not whether silver dipped. The next question is what that dip is actually preparing the market for. The meaning, why the dip, changed the market's psychology. Once the forced selling began to slow, something subtle but important started to happen. The market did not immediately rebound, and it did not continue collapsing either. Instead, it hesitated. That hesitation was not weakness. It was the moment when fear stopped spreading automatically and thinking slowly began to return. For experienced observers, this pause mattered more than the drop itself. Sharp declines are dramatic, but pauses reveal intent. When a market absorbs heavy selling and does not continue to fall at the same speed, it suggests that pressure is changing hands. The urgency that drove the dip begins to fade, and with it, the emotional narrative starts to lose control. This is where interpretation becomes critical. Many participants see a large dip and assume it signals the end of a move. In reality, in fast-moving commodity markets, deep pullbacks often serve a different purpose. They test conviction, They force out weak positioning. They separate those who were present for momentum from those who are present for structure. Silver's dip did exactly that. It created discomfort. It forced questions. It challenged assumptions that had formed during the rapid rise. This discomfort is not accidental. Markets that rise without resistance become fragile. They attract excessive leverage and unrealistic expectations. A sharp pullback interrupts that process before it becomes dangerous. What made this moment especially powerful was the shift in psychology it created. Before the dip, attention was focused almost entirely on higher prices. After the dip, attention shifted to survival and stability. Participants began asking different questions. Not how high can this go tomorrow, but where does it hold? That shift in mindset is often the foundation of a more sustainable trend. Another important change occurred beneath the surface. As forced sellers exited, the remaining participants were, by definition, stronger. They were less leveraged. They were less reactive. They were more deliberate. This does not mean they were optimistic. It means they were prepared. Markets tend to function better when participants are prepared rather than excited. At the same time, volatility itself began to change character. Early in the dip, price swings were violent and unpredictable. Later, movements became more measured. This transition is subtle, but it signals a reduction in mechanical pressure. When volatility compresses after expansion, it often indicates that the most urgent imbalances have already been resolved. For long-term observers, this phase is often misunderstood. Many mistake reduced volatility for disinterest. In reality, it often reflects reassessment. Serious participants step back, evaluate conditions, and recalibrate expectations. This is not the moment of headlines. It is the moment of positioning. There is also a broader lesson embedded in this phase. Silver's dip reminded the market that rapid gains come with consequences. It reinforced discipline. Participants who experienced the pullback learned something valuable about risk, timing, and exposure. Markets that teach these lessons early tend to avoid more destructive outcomes later. Crucially, the dip also changed how future price movements would be interpreted. After a sharp correction, higher prices are no longer seen as effortless. They must be earned. This reduces complacency. It encourages more careful participation. In strategic terms, this shift often strengthens the foundation of the market rather than weakening it. However, this is also where danger remains. After a major dip, narratives compete. Some declare the move finished, others expect immediate recovery. Both extremes miss the point. Markets rarely reward certainty after periods of stress. They reward patience and observation. The real suspense at this stage lies in what cannot be seen immediately. The market is no longer driven by fear alone, but it has not yet revealed its next direction. This uncertainty is uncomfortable, especially for those who need clarity. But uncertainty is not the same as risk. In many cases, it is simply the absence of noise. For silver, this moment represented a psychological reset. Expectations were lowered, excess confidence was removed, and attention shifted from price to behavior. These are not signs of collapse. They are signs of digestion. The mistake many participants make is assuming that strength must always look aggressive. In reality, some of the strongest phases in markets begin quietly after the loudest moves have already passed. They begin when pressure is relieved and perception stabilizes. At this point, the market was no longer asking whether silver could fall. It was beginning to ask who was still standing. And that question carries far more weight than any single price level. The implications. What this dip is quietly setting up. As the dust settled, the silver market entered its most dangerous phase. Not because of falling prices, but because of false clarity. After extreme volatility, many participants believe the hardest part is over. In reality, this is when mistakes become more subtle and more costly. The dip changed the structure of the market, but it did not announce what comes next. That uncertainty is intentional. Markets do not reward those who demand immediate answers. They reward those who observe behavior. At this stage, silver was no longer testing price levels. It was testing discipline. One of the most important implications of the dip was how it reset expectations. Before the fall, optimism was widespread and often unexamined. After the fall, confidence became conditional. Participants began waiting for confirmation rather than chasing momentum. This shift matters. Markets built on confirmation tend to move slower, but they also tend to last longer. For serious participants, the focus now moves away from headlines and towards signals. Price alone becomes less important than how price behaves. Does selling accelerate on weakness, or does it slow? Do rebounds appear chaotic or controlled? These questions reveal more than any forecast ever could. Another critical implication lies in relative value. After the dip, silver is no longer judged only by its own movement. It is compared more closely to gold, to other commodities, and to broader financial conditions. This comparison forces clarity. If silver stabilizes, while other assets weaken, perception changes. If it weakens less during stress, confidence rebuilds quietly. This is where many observers lose patience. They expect resolution, either a sharp recovery or a clear breakdown. But markets often choose a third path, consolidation. This phase frustrates those who crave action, yet it is during consolidation that real positioning occurs. Institutions do not chase volatility, they wait for imbalance to resolve. There's also a strategic warning embedded in this moment. After a major dip, narratives tend to simplify. Some will declare victory, others defeat. Both views ignore complexity. The dip was not a verdict, it was a process. Treating it as a conclusion risks misreading the next phase entirely. From a risk perspective, the market is now less fragile than it was at the peak. Excess leverage has been reduced. Emotional positioning has been shaken out. This does not guarantee higher prices, but it changes the conditions under which prices move. Future advances, if they occur, are more likely to be deliberate than explosive. At the same time, danger remains for those who confuse calm with safety. Reduced volatility can create complacency. Participants may reintroduce leverage too quickly or assume stability is permanent. Markets have a way of punishing those who forget recent lessons. The dip taught discipline. Ignoring that lesson invites repetition. For decision makers, the most important implication is behavioral. The dip revealed who reacts and who observes. Those who reacted were forced to make decisions under pressure. Those who observed gained information. Over time, information compounds. Reaction does not. This phase also separates strategies. Short-term traders seek resolution. Long-term participants seek structure. The market does not need to reward both at the same time. Often, it does the opposite. Understanding which group is being tested helps explain why price behaves the way it does after major moves. Perhaps the most uncomfortable truth is this. The market does not owe clarity to anyone. Silver does not need to justify itself after a dip. It only needs to reveal how participants behave next. That behavior will determine whether the correction was a pause or a turning point. And this is where suspense truly lives. Not in price targets, not in predictions, but in observation. The next phase will not announce itself with headlines. It will show itself through restraint, through balance, and through the absence of panic. Those who are watching carefully will notice when fear no longer controls decisions, when volatility no longer forces action, when the market stops reacting and starts choosing. By then, it will be obvious what this dip was preparing the market for. But by then, it will also be too late to react.